Every second, millions of dollars move through crypto exchanges. Traders celebrate profits. Others get liquidated instantly. But here's the real question. If traders are constantly winning and losing, how do crypto exchanges always make money? And what really happens when millions get liquidated? Crypto exchanges are digital marketplaces. They connect buyers and sellers. But unlike normal investing apps, crypto exchanges are designed for constant activity. More trades, more volatility, more emotion, because every click generates money for the exchange. The real engine behind crypto exchanges is futures trading and leverage. Leverage allows traders to borrow money to open larger positions than they can actually afford. Instead of trading with $100, someone suddenly controls $5,000 or more. And this is where the system becomes dangerous, because leverage magnifies everything. Small profits become huge wins, but small mistakes become disasters. A tiny price movement in the wrong direction can completely erase a trader's account within seconds. This is called liquidation. Liquidation happens when the exchange automatically closes a trader's position because losses become too large. The system protects itself first, not the trader. And during market crashes, liquidations happen everywhere at once. Millions disappear from accounts almost instantly. But here's the part many people never think about. Where does all that money go? Because money inside the market doesn't simply disappear. Winning traders profit, market makers collect liquidity, and exchanges continue collecting fees every second during the chaos. In fact, volatility is extremely profitable for exchanges. Fear creates more trading. Greed creates more trading. Panic creates more trading. And inside the crypto market, emotion spreads faster than logic ever can. That's one of the biggest reasons why crypto trading becomes addictive for so many people around the world. When traders win, the feeling is powerful. A successful trade can create an emotional high that feels almost unreal. One green candle, one lucky position, one sudden price explosion, and suddenly someone feels smarter, faster, and more confident than everyone else in the market. Profits create excitement. Excitement creates confidence, and confidence creates bigger risks. Many traders start small, maybe with a few $100s, maybe even less. But after a few successful trades, something changes psychologically. The market begins feeling predictable. Traders begin believing they understand the system. That's usually when emotions begin taking control. Because in crypto, confidence can disappear in seconds. A trader who feels unstoppable during a bull market can suddenly panic during a crash. One aggressive candle downward, one unexpected liquidation wave, and profits built over months can disappear instantly. And losing money creates a completely different emotional reaction. Revenge trading. The desire to immediately recover losses becomes extremely dangerous. Traders tell themselves they only need one more trade, one more opportunity, one more good entry. But emotional decisions inside volatile markets usually create even larger mistakes. That's why so many traders stay awake all night staring at charts. Endless scrolling, endless analysis, endless stress. Some people check prices hundreds of times per day without even realizing it. Crypto becomes more than investing. It becomes emotional attachment. And exchanges understand this extremely well. Every part of the platform is designed to keep users engaged for as long as possible. Flashing numbers, moving charts, trending coins, price alerts, profit calculators, leverage buttons, liquidation warnings. Everything is built around attention, because attention generates activity, and activity generates profit. The longer traders stay emotionally connected to the market, the more trades they place. And the more trades they place, the more money flows into the system. But while millions of retail traders fight emotionally against the market every day, there's another side of crypto operating at a completely different level. The whales. Large investors capable of moving enormous amounts of money with a single trade. Some whales are wealthy individuals. Others are investment firms, market makers, trading groups, or institutions controlling hundreds of millions of dollars. And when these players move aggressively, the market reacts immediately. A large sell order can trigger panic across social media within minutes. Twitter explodes. YouTube thumbnails appear instantly. Telegram groups fill with fear. People rush to close positions before prices fall further, and that panic creates chain reactions throughout the entire market. Liquidations begin stacking on top of each other. Long positions get wiped out. Stop losses trigger automatically. More selling pressure enters the market, and suddenly billions of dollars disappear from crypto within hours. Sometimes the market crashes so violently that traders believe something must be manipulated behind the scenes. And honestly, many traders truly believe manipulation exists everywhere in crypto, because price movements often feel unnatural. Sometimes Bitcoin crashes aggressively, only to recover minutes later. Other times prices pump suddenly, attracting thousands of new buyers, before collapsing immediately after. To inexperienced traders, it feels random. But inside professional trading environments, one thing matters more than emotion: liquidity. Liquidity is where money exists in the market. Large players constantly search for areas where traders place stop losses, liquidation levels, and emotional entries. Why? Because those areas contain enormous amounts of automatic orders waiting to activate. Once price reaches those zones, everything begins moving rapidly. Stop losses trigger automatically. Forced selling begins. Liquidations increase. Fear spreads faster, and volatility explodes. This creates what many traders call stop hunts, moments where price aggressively pushes into crowded positions before violently reversing direction. Whether intentional or not, the result is always the same. Retail traders lose emotionally, and volatility increases dramatically. But while traders experience stress, panic, excitement, and emotional exhaustion, exchanges continue operating profitably in the background, because exchanges do not need traders to win consistently. They don't even need the market to go up. They simply need activity. Bitcoin can rise 20%. Bitcoin can crash 40%. Altcoins can explode overnight or disappear completely. As long as traders continue opening positions, fearfully reacting to candles, chasing profits, and trying to recover losses, the system continues generating revenue every second. That's why crypto exchanges became some of the most profitable companies in modern finance. Within only a few years, they discovered something incredibly powerful about human behavior. Hope is profitable, fear is profitable, greed is profitable, panic is profitable. Even addiction can become profitable inside financial systems built around constant emotional engagement. And maybe that's why crypto feels different from traditional investing. Traditional investing often rewards patience. Crypto often rewards emotional intensity. Fast moves, fast reactions, fast profits, fast destruction. Some traders enter the market dreaming about financial freedom. Others dream about escaping difficult jobs, debt, or economic pressure. Many believe crypto will completely change their lives. And for some people, it actually does. Some traders become millionaires. Some build successful businesses. Some change their futures forever. But many others lose money chasing unrealistic expectations inside one of the most emotionally volatile markets ever created. And despite all of this chaos, one thing never changes. The exchange keeps making money. Every trade, every liquidation, every emotional reaction, every moment of volatility. The machine continues operating, which leads to one final question. Are traders really controlling the market? Or is the market slowly controlling them?